So another way we can use that is all just dovetailing off of, I'm going back to the original chapter 10 notes, dovetailing off of this deferred payment discussion we had. Um, Another way we can purchase assets is through like a lump sum approach. Like we're purchasing multiple assets in a single deal. A lump sum purchase, a basket purchase. Excuse the coffee stain. I set my coffee mug there. So we're buying a lump sum for of several components. The way that we want to do this is we want to allocate the total cost based on the relative fair value of each asset. And how we figure out a fair market value for these could be insurance appraisal, property tax assessment, or some other independent assessment, go to a valuation specialist. So for example, we might have land, building, and fixtures. We buy this for $450,000, and we'll assume that it's cash this time just to keep it it's more simplified. And we're buying all three of these for $450,000 of cash. Now, these are the fair value appraisals of each of these assets that we bought. And remember, we packaged this all up for $450,000. But if we look at the fair value of each of these things separately and independently, it actually comes up to $500,000. So how do we, what becomes the problem is we have a credit for cash of $450,000, and we bought three distinct assets: land, building, and equipment. I can't just record their fair values, because then I'll come up with an amount that does not equal the acquisition cost. And so in order to understand how I'm going to allocate the 450 to each one of these items, I just look at, well, what percent land is 100,000 of each of the individual fair values added up. And so that gives me a 20% proportion of the total fair value. Then I look at the building, and if it's 350,000, and what percent of 500,000 is that? That would be about 70%. And the fixtures have an independent appraisal of 50,000. And when you add all three of those assets up, their total appraisal is 500. So that's about 10%. Now, taking each of these percents, and if you're like, okay, well, that 100 is 20% of 500, 350 is 70% of 500, 50 is 10% of 500, then if I spent $450,000 cash for all three of them, then I can use that amount of cash, and the fact that this is 20% of the total value, to come up with the land must be like about $90,000 based on my historical acquisition cost of 450. 70% or 10% of 450 would be 45. Do the easy one first. Then that's 135 together. So that means that 70% of 450 should be 15 and $315,000. So that's how I allocate the value of those items, given that I gave up $450,000 for them. What folks usually mistakenly think of is, oh, I bought these, I got some sort of a gain on purchase or something along those lines. And that's not, you never record gains or losses on purchases. You only record gains and losses on sales. The fact is, I exchanged $450,000 for these three items. Their value is therefore locked into the fact that I spent that amount of money. It cannot rise above that amount of money, even though they're independent fair value appraisals, suggest that if I sold each one of them separately, I could get more for them. That's not the case. I bought them in a bundle. That bundle restricted their value, and so I have to record that restricted value when I put them on my balance sheet. We could also issue stock for fixed assets. And this is where the general rule of thumb that we want to judge the asset based on the fair value of what was exchanged. So when we're determining the asset value of what we're acquiring, we look at the fair value of what was exchanged or the fair value of what was acquired. And so, i.e., what is the fair value of the asset that I required could be the basis of my decision to record the asset value or the fair value of what was exchanged. When we apply that to the lump sum, it is much easier to readily identify the fair value of what I exchanged. I exchanged for $50,000 of cash. That is its own value. Getting tax appraisals and property assessments on 3 individual items and understanding that that doesn't capture the fact that I didn't buy each one individually, I bought them all together. Those values are not as good of a valuation as the fact that I spent $450 to get them. That's what priced these assets, right? When I was exchanging notes for equipment, it was the fair value of the note, i.e. its present value, 60,000 less this discount, that gave me the value I want to put on that equipment. So it's the present value or the fair value of what I exchanged. Was it cash? Was it a note? Is it, in this case, stock? Or the fair value of what was acquired, the asset I bought. Almost always it's going to be easier to determine the fair value of what you gave up. It was yours before you gave it up. You have a better idea of its value. What you're getting might not be as familiar to you. And the instance of equity is one of the times where it can actually go both ways. So let's say if we have a publicly traded stock. So my company has shares that are traded on the NASDAQ or the NYSE, and people are trading the value of the stock all the time and has a pretty set value. Then if I'm giving up stock, the fair value of what I exchange, the market value of that stock on the day that I give it up for a new asset is typically the best indication of what I'm acquiring. Why is that a great indication? Well, if you have a market value that's actively traded, you have multiple buyers and sellers, and an equilibrium price. So that's going to be much more informative because it's being sold and bought all the time. Its price is more likely to be exact than the huge piece of machinery that you're trading them for that has a lot of modifications. There's not a market for those machines. There's not an agreed upon, people aren't buying and selling them on a regular basis. So you can get, for example, like an auction price or a Kelley Blue Book value. So then the stock becomes more informative. And that's what we use to base the value of the fixed asset. So let's look at this example real quick, and then I'll talk about the template of the journal entry I have. It says we financed the acquisition of some land by issuing $10,000 of $1 par value common stock. At the time of the exchange, the company's stock was trading at $40 per share, so that's its market price. Provide the journal entry to record the acquisition. So 10,000 shares were exchanged. And if each of those shares has a price of $40, then that amounts to a $400,000 total value of stock. So based on its current market price. So that is the value of the land. If I had to give them 10,000 shares and each share is $40 a share, then that is what I use to set the value of my land, because I have an active market that's being used to assess the value of my stock. Now, the stock is recorded a little silly based on our old arbitrary rules about common stock versus APIC. We only record the common stock account proper. When I say proper, I just mean common stock, its name, its literal account name. At the common stock part of it is only at par. So these were $1 par value. And so that's limited to $10,000 because there were 10,000 shares. And then any excess is what we put into additional paid in capital. And I'm just going to shorten it APIC, common stock, APIC. And that takes up all the excess price. It's the additional amount that was paid over par to meet the value of this asset that we acquired. Now, this is all equity, of course, equity accounts, common stock, APIC, common stock. The land, of course, is an asset account. In some of the problems, it just says zero par value stock. If it's zero par value stock, you don't have to worry about the difference between these two. You can just put it all into common stock. Basically, most companies have a par value that's close to zero, just to avoid this issue with having to record some in common stock and some in APIC. And so if it had a zero par value stock, then it just simplifies. We still use the $40 of 10,000 shares as the basis of the value, but we don't have to worry about recording it into two different equity accounts. So that's all that changes if it's a zero par value. Now, in this next example, the common stock isn't actively traded. So maybe it's not publicly traded. It's a private company. They're offering maybe like 10% equity in the company, but you can't go and trade it on a market because it's a private company. Or maybe it's thinly traded, which means that it's on the market, but people aren't buying it and selling it on a consistent basis. So the equilibrium price isn't necessarily set. The price it's at may or may not be a good basis for its value. Well, in this case, right, we're trying to figure out what to put the asset at. Is this value of the private stock, is that a readily determinable amount? Or is maybe, do we have to go to what we're acquiring? Well, since it's private, if it's thinly traded, that means we might not have a good lock on what the market price is. Then I might need to go to, well, let me think about what the value of what I'm getting is. So in this case, let's say Bevo financed the acquisition by offering, again, 10,000 shares of its $1 par value stock. The stock is not publicly traded, has no market value. And we do have a recent appraisal from a bank that suggested the value of the land was $375,000. So in this case, we might have a more compelling argument to use the value of what we're getting as the basis of valuation. And then we just allow the common stock to absorb that value. So in this case, right, the common stock determined the value. This was just the result. This 450 was just the result of stock's value. Now, the amount we're recording, the 375, the common stock and the APIC common stock we're going to record is the result of the acquired assets value. So it's the result of having the land appraised and then fitting the stock to that value. The rules still are the same. The common stock account is locked at par. I have 10,000 shares, $1 par value. So that's still 10,000. And then my APIC just becomes, again, still the plug, $365,000, because then 365 plus 10 gives me the 375 of land. So it's just about which one you're going to value first. It's either going to be the stock that's valued because it's inherently easier to value. It has a market price, it's actively traded. And then that becomes the value of the land because it's what we gave up to get the land. Or this case, the stock is private, not publicly traded, doesn't have a readily determinable price that we can use to value the land. So we take the land's fair value from an independent source, like some bank that went and appraised its value, maybe a property tax value. And we say, well, the land is worth 375, therefore the stock that we gave up must be worth that amount. We're going to make it fit because of a result of the asset we're acquiring.